In the intricate world of Forex trading, understanding the communications of central banks is paramount. The statements and speeches delivered by central bank officials contain valuable insights into monetary policy decisions, economic outlook, and future interest rate changes, all of which can significantly impact currency markets. In this comprehensive guide, we'll delve into the art of decoding central bank communications to uncover valuable Forex trading signals. Understanding central bank communications. Central banks play a pivotal role in shaping monetary policy and economic stability within their respective countries. Through various channels, including press conferences, speeches, and policy statements, central bank officials communicate their views on economic conditions, inflation expectations, and policy intentions. These communications are closely scrutinized by traders and investors for clues about future monetary policy actions, which can influence currency valuations and market sentiment. Decoding central bank speeches and statements. Central bank speeches and statements are carefully crafted to convey key messages to the financial markets while avoiding unnecessary volatility. Traders must analyze these communications diligently to extract meaningful insights that can inform their trading decisions. Here's how to decode central bank communications effectively. 1. Analyzing economic assessments. Central bank officials often provide assessments of current economic conditions, including GDP growth, inflation, employment, and trade balances. Traders should pay close attention to these assessments as they offer valuable insights into the overall health of the economy and potential future policy actions. Positive economic assessments may signal a hawkish stance, suggesting potential interest rate hikes, while negative assessments could indicate a dovish stance, implying potential rate cuts. 2. Monitoring forward guidance. Forward guidance refers to central bank officials' indications of future monetary policy actions and their intended path for interest rates. Traders analyze central bank statements and speeches for clues about the timing and direction of future policy changes. For example, hints of tightening monetary policy, such as references to inflation concerns or improving economic conditions, may strengthen the currency, while indications of easing, such as concerns about low inflation or weak economic growth, may weaken the currency. 3. Identifying policy rhetoric. Central bank communications often contain nuanced language and rhetoric that can provide valuable insights into policymakers' intentions. Traders must decipher the tone and emphasis of central bank statements to gauge the likelihood of future policy actions. Keywords and phrases such as data-dependent, patient, gradual, and balanced risks can signal policymakers' stance on interest rates and the broader economic outlook. Strategies for trading central bank communications. Trading central bank communications requires a disciplined approach and careful risk management. Here are some strategies for incorporating central bank signals into your Forex trading. 1. Event-based trading. Traders can capitalize on central bank announcements and speeches by trading around scheduled events such as interest rate decisions, monetary policy statements, and press conferences. By monitoring economic calendars and staying informed about upcoming central bank events, traders can position themselves strategically to take advantage of potential market movements. 2. Reaction-based trading. Instead of preemptively entering trades ahead of central bank events, some traders prefer to wait for the market's reaction to central bank communications before making trading decisions. This approach allows traders to assess the market's interpretation of central bank signals and capitalize on potential trends or reversals that emerge following the release of key announcements. 3. Risk management. Trading central bank communications can be volatile, and unexpected market reactions are common. Traders must implement robust risk management strategies, including setting stop-loss orders, managing position sizes, and diversifying their portfolios to protect against adverse market movements and minimize potential losses. Conclusion: decoding central bank communications is a crucial skill for Forex traders seeking to navigate the complexities of the currency markets. By analyzing economic assessments, monitoring forward guidance, and identifying policy rhetoric, traders can uncover valuable trading signals hidden within central bank speeches and statements. By employing strategic trading approaches and implementing effective risk management strategies, traders can capitalize on central bank communications to achieve success in Forex trading.